Welcome back to Thea. I'm Joe Consorti. Today we're sitting down with one of the most well-respected analysts on Twitter, Caleb Franzen, the founder of Cubic Analytics. I'm really excited to talk to him today. We're going to talk about the stock market, everything that's been going on there, Bitcoin, Ethereum, what on earth is going on with U.S. markets, and a whole lot more. So, Caleb, welcome to the show, man.
Bro, great to see you. We had a little private conversation about 2 weeks ago, I think, and it was great to connect. And when you hit me up to come on the show, couldn't have been more excited. So glad we're making this happen, man. Good to see you.
Likewise, man. Good to see you too. Well, yeah, let's just kick things off here. What's been going on in the stock market? What do you have your eye on? Obviously, NVIDIA, technical correction. Over the last 18 months, you have been famous for calling out all the bears, where they are. There are so many perma bears, even still. Yeah, just kind of walk us through where your head's at, and then we'll go from there.
Yeah, I think, there's been a really big conversation on X, probably for the past 15 months plus, right? Really since the birth of this bull market, but it kind of comes in waves and it goes away and it comes back. But what is that topic? It's been weak breadth, right? And a lot of people like to complain about the fact that the best stocks, the largest stocks in the world are leading the market higher, right? And I'm just simply not one of those people. The phrase that I've been saying basically for the past 15 months is I want the MVPs of the market to act like MVPs. I want LeBron James to go out and put up a triple-double. I want Steph Curry to go put up 10 three-pointers in a game, right? I want my best players on my team performing the best to give my team the best chance to win. And so I see stocks the same exact way. I want to see the Magnificent Seven outperform everything else. And so, yes, NVIDIA, Apple, Amazon, Google, all of these things are doing extraordinarily well in this market. If you look at mega cap growth, if you look at mega cap tech, if you look at equal weight tech, actually are all doing very well. Growth is outperforming value. There's all these different things taking place. However, all of those things are generally characteristic of bull market uptrends, right? We don't see growth outperform value in a bear market. We don't see growth outperform value in a recession. And so ipso de facto, if growth is outperforming value, we're probably not in a recession. We're probably not in a bear market. So, if the music's playing, you have to dance, right? That's kind of been the theme that I've been saying. Of course, recession risks are always present. If anyone can show me a time in U.S. economic history where risks are not present, I would love to see that time. It's just a fact of the market. In order to capture returns, there must be risk, right? And so we can focus on those risks. We can be aware of them. We can manage that risk. But I think that, like I said, when the music's playing, you got to dance. And I want the MVPs of the market to act like MVPs.
Absolutely. And it's a great introduction because for the longest time, and I certainly was a victim of this as well, seeing individual data points and then saying, oh, this is the one that's going to turn the market. This is the one that's going to turn the market. But in reality, this is kind of all cycles have risks. But yeah, no, you want the MVPs to be the MVPs. People look at the winners and they say, oh, the market's propped up on stilts. But how did the MVPs become the MVPs? Because they're the most well-run companies. And you want that to happen. That's, you want companies to drive returns. That's how they end up driving the stock market. Of course, they're going to make up a higher percentage. But when LeBron James is leading in points, you don't say that, oh my goodness, the Los Angeles Lakers are at serious risk of, right? You give more playing time to LeBron James. I don't know what team he's on. I don't follow basketball, but you get my point. That's exactly what you're saying.
Yeah.
Any more thoughts on that particularly? Because we're going to talk about it more, but I do want to ask you about the M2 money supply. You had a tweet back in May about that.
Okay. Let's talk a little bit about stocks a bit more. Is it possible to share my screen on here?
Yes, it is.
Let's see. Okay, wonderful. So I saw this chart come out from Sonu Varghese from Carson Investment Research. And this is looking at the forward 12-month earnings per share for the S&P 500. And so we could see that this bottomed, in Q1 of 2023, and forward EPS expectations have been rising gradually, right? So when we think about the market as a forward-looking pricing mechanism, it is pricing in this upward trajectory in earnings per share, right? The market, asset prices are just the present value of future cash flows. And if future cash flows are rising continuously, this is what's really been contributing amongst a variety of other topics and factors to the ongoing bull market, right? And so I think this is super important. Another chart that I wanted to talk about as well was this one right here. So if we look at the S&P 500 and its current valuation, I think the trailing 12-month price to earnings ratio is around 23 or 24, somewhere around there. But look, a lot of that is coming from the top 10 names in the S&P 500, trading at almost a 28x multiple. But when you look at the S&P 490, the X top 10, they're trading at a 16.4x multiple, certainly a little bit more expensive than the long-term average, right around 15. But this is generally telling us this is not a market that is in peak exuberance, bubble behavior, anything like that, right? There's still a lot of names in the market. In fact, the majority of names in the market are trading at fair value relative to historical trends, right? And so when we kind of contextualize both of those charts, which is forward EPS estimates are rising, and when we look at current valuations still being relatively tame for 490 out of 500 stocks in the S&P 500, first of all, I also want to mention, right, the top 10 names in the market, the MVPs of the market, should trade at higher multiples. They should be more expensive. Let's go back to my basketball analogy. LeBron James makes over $40 million per year. Probably the average NBA salary is close to 8, right? So he's trading at a 5 times multiple relative to the average. So you're going to pay up. It's the same reason why a Rolex is more expensive than a Casio and Audi is more expensive than a Honda. You pay up for value and you pay for what you get for. And these companies, the top 10 in particular, continue to deliver great results year after year after year. You mentioned it kind of in your question, but the reason why they've gotten to be the biggest and best companies is because they've shown that track record of outperformance versus the rest of the market. They've always traded at a premium relative to the rest of the market, and they always deliver on that premium. So again, I think this is really important context for where is the market right now based on actual core fundamentals.
Very well said. Very well said. I mean, given historical norms, stocks are fairly valued. Like a lot of analysts will fall into the trap of, and just fair weather stock market participants will fall into the trap of looking at the absolute level of the S&P 500 and saying, well, oh my goodness, it's up and to the right. Therefore, it must come down. It must crash. I think a lot of analysts get it wrong there. What other areas do analysts get it wrong in? Because you've been so consistently correct on the direction of the market and the risks posed. Yeah, where do other analysts get it wrong, do you think?
I think two things. We're in a very macro-dominated environment. I hate when people say we're in a data-dependent market. We're always in a data-dependent market, but I think one thing's for sure is that more people than ever have access to that data and can voice their interpretation of it. One thing that I see a lot of people make a mistake about is just focusing on half the picture, right? It's like they want to only focus on consumer credit, but they don't want to talk about household net worth, household incomes, debt to service ratios. They don't want to focus on the holistic picture. The same way that a lot of people talk about, part-time jobs, right? And it's like, oh, part-time jobs are growing, full-time jobs are declining. But let's contextualize both of those, right? And when we do, we see that only 5% of people, what's the data point? It's the percentage of people who are employed who are working part-time jobs is 5.2% of the total amount of people who are employed. Sorry about that. And so again, it's like, are we really going to worry about that 5% figure? Or are we going to focus on the 95%, right? Like, let's not miss the forest for the trees here. And so I think that's kind of first and foremost, people only focusing on half the picture. The second thing is, I think a lot of people operate with a degree of hubris that they know better than the market. And I think one of the things that I had to learn maybe 8 or so years ago, as I kind of dabbled in technical analysis, was just simply recognizing that the price of any asset, the price of the market, the S&P 500, let's just say, is the equilibrium of supply and demand. And supply and demand are influenced by a multitude of factors. But at the end of the day, all of those multitudes of factors, current data, expectations of future data, are boiled into price today, right? And so the market might not be perfectly efficient, but it is the most efficient thing that we have. And so I think if you just default to recognizing that the market is a forward-looking pricing mechanism that is an aggregate of all market participants' expectations, and if you study price, trend, direction, some statistical indicators, you can really get ahead of most people just by saying, like, look, I was very bearish in 2022 from a short-term perspective. I was a little bit late to that, but then I got onto the right side of the trend. And then in the first quarter of 2023, I said, okay, man, I was predicting a recession for 2023, but I'm seeing what the stock market is doing. I'm seeing the resilient and dynamic nature of the US economy on the aggregate. Are things perfect? Are they rosy? No, they're not. There's holes, there's cracks, there's weaknesses everywhere. But on the aggregate, taking the weight of the evidence, things look okay. And so I started to say, man, if in that backdrop, especially in a disinflationary environment, if asset prices are trending higher, that wouldn't happen if the market was pricing in a recession. There's something here. The market is trying to tell us something. And I put aside kind of my preconceived notions, my expectations 2023, and I said, shit, the market probably knows more than me. I'm going to listen. The market is trying to tell me something. I'm just going to listen. And so I think a lot of people just don't listen, actually.
Yeah, well, I think hubris is a major component to it. I think a lot of it can be explained probably in like the post-2008 world where everyone wants to be the next Michael Burry of sorts. And so instead of viewing the market as what it is, like you said, the best forward discounting mechanism, because it's the aggregate of every single investor's opinion of supply and demand, the chances that you or I are always going to be smarter than that are slim to none, right? And so we've started thinking that outlier events are the norm, and that's how analysts view everything instead of viewing the market for what it is and then moving with it. What did it take you to overcome that proclivity to think the market is wrong and try to move against the market and kind of be a contrarian investor? What did it take you to recognize that the market more often than not is right, and you make money going with the trend rather than bucking it constantly?
Yeah, so I guess maybe that answer requires a little bit of background about kind of how I came into macro and the whole 9 yards, but I really came across Peter Schiff early in my discovery of macroeconomics, right? So this was 2013 going into 2014. Came across Peter Schiff as I was studying Austrian economics and just saw him like trashing people on, regular financial TV, right? There's like some highlight clips of him, if you will. And so I really got into that kind of doomer mentality, really focused, again, like I said, kind of only on half the picture, really focused on these negative dynamics. And, was a massive gold bug and was very fearful about the bubble in the market and so on and so forth. And, that was in 2014, like I mentioned, I'm seeing the market go higher. 2015 was a little bit choppy, but then I'm seeing the market go higher. 2016, then in 2016, I discovered technical analysis. And I think for me, that was a really big kind of turning point for me, just kind of overall. And then continuing to think critically about what are the important factors that are actually driving market returns. Because I love macro. I love talking about the Fed. But I'm not an academic. I'm not trying to get my PhD in economics. I'm not here to talk about the nuances of Fed funds futures and swaps and Eurodollar futures and the whole 9 yards. They're interesting topics, but how does it help me as an investor either match or outperform the performance of the S&P 500, right? If 80 or 90% of hedge funds underperform the S&P 500 over a 10-year period, clearly this is really difficult. So what are the key pieces of information that I can use to give myself the best chance to at least match the performance, right? And so I really had to kind of think critically about where did Schiff kind of get things wrong, if you will, from his inflationary prediction, his dollar doomerism, his economic crisis prediction, so on and so forth. And I really had to think about that a lot. I'll give a lot of credit to Brent Johnson and the dollar milkshake theory. When I kind of discovered that in 2016-17 was very big for me as a turning point, the dollar being the cleanest shirt in a dirty laundry basket. And I think the other big turning point for me was recognizing that QE, fiscal deficits, all of these different things, Schiff and doomers often warn about those things as being inflationary. They are inflationary, but not so much for consumer prices. For asset prices, right? All of these things increase the value of dollar-denominated assets, right? And certainly consumer prices are going to rise over time. Joe, you and I would 100% agree with that. It's one of the reasons why the CPI, the consumer price index itself, is almost always gradually rising. It's one of the reasons why I said it's bullshit that the Fed targets price stability. They actually target inflation stability of 2%. This is why their mandate or their target is 2%, right? They're always trying to erode the purchasing power of the US dollar. And so in that environment, the best thing that you can do is take on debt at very low fixed interest rates and buy assets for the long run. And so I kind of had that turning point and said, man, yeah, the Fed is going to keep doing QE infinity. Peter Schiff is right about that. And so what does that mean for the stock market? What does that mean for asset prices? What's the fastest horse in the race that I could get attached to, right? So I start going down that rabbit hole, saying, man, I want to own the S&P, I want to own tech, I want to own Bitcoin, and I just want to hold on for the long run. And by the way, I also want to own the MVPs of the market, right? So again, that's kind of been my overall notion. Where people get that wrong, I'm not entirely sure. I think there's so many different ways. Again, I think it's so interesting and so niche. There's so many ways you can take macro. You can focus on this data point versus that, this economy versus that economy, how this institution is impacting this data point, so on and so forth. And yeah, it makes for very interesting cocktail discussion, right? But if we're here to invest for the long run, increase our net worth, give our families and our future families a higher standard of living than ourselves, then most likely we just want to own assets for the long run.
100%. Yeah, you can look at these things and say that eventually this is going to cause a problem, and then sit on the sidelines and wait for a shorting opportunity, or you can buy and hold and benefit from everything we know that they're going to be doing, right?
That's
Instead
right.
of waiting for the bad outcome that will happen down the road, who knows when, right? At that point, you're playing a guessing game. Why not do a sure thing and just put your money that is directly appreciating as a result of all the things you're doing?
Yeah, no, I couldn't agree more. And there was something that I wanted to tag on to with that, with what you just said. Now I already skipped my mind. But, I think most of the money gets made in the market by betting that the end of the world is not around the corner, right? And there's certainly a time to be bearish. Like, I was short-term bearish in 2022. We had the trend deteriorate. Let's think back to 2022. The market going into that year was only expecting 2 to 3 Fed rate hikes. We ended up getting magnitudes more than that. Right? And even going into that year, I was saying I kind of expect to see below average market returns. And I said, if the Fed hikes more than we're currently expecting, aka 2 to 3 times, then things are going to get bad very quickly. And that's exactly what happened. But then in the middle of the year, I went on Pomp Show, I spoke with Julia LaRoche, and I was saying, man, some of these companies, look at Amazon, it's down 50% from the all-time highs. Google down more than 40%. These are massive buying opportunities in the second half of 2022. So again, there's a time to be bearish, especially from a short-term perspective. You can't operate with cognitive dissonance based on the fundamental reality of the market that we're operating in. There's going to be downtrends. That's just a basic fact, right? We're going to have recessions. There's going to be downtrends. There's going to be bear markets. But again, if we operate from a long-term perspective, zoom out, stomach some of that short-term volatility, I think generally speaking, we want to be investors for the long run.
Absolutely, that's where the money is made. And I'd like to share my screen for a moment just to give viewers who are watching not in their pockets some context. This is what we're talking about here, right? So post 2020, I mean, this has been basically one big bull market, right? But 2022, this was a period where we had a very, very lengthy, lengthy in terms of like a correction, but kind of a little bit of a protracted bear market. How do you view what has occurred since this point here, the March 13th, 2020 crash to now? How has the market developed in your eyes? And what did you see here around 2022 that caused you to believe the trend was deteriorating and become short-term bearish?
I remember there was a very key trend line coming off those COVID lows that we had broken down. And then at the same time, the Fed came out in November of 2021 and said, we are gearing up. That's when they announced that they were going to start tapering their asset purchases, basically signaling to the market, we've reached an inflection point of QE and we are now shifting towards tightening. And so that stance overall, that shift, if you will, gave me some pause going into 2022, but I certainly was not expecting to see a 20% decline in the S&P 500 in 2012. I want to be very clear about that. I expected below average market returns for 2022, but I certainly wasn't expecting one of the most risk-off environments we've seen in my trading experience over the past 10 years. As we kind of zoom out and look at the price action since the beginning of 2020 and those COVID lows, if we really think about how has this chart shaped up the way that it has, I mean, fundamentally, this is a QE monetary bazooka followed by improving fundamentals in terms of corporate earnings and multiple expansion, right? It really just comes down to those three things, right? And so I think on top of that, right, one of the ways I've described the economy over the course of the past 15 to 18 months is I don't think I've ever described the economy as being strong. How I've described it is resilient and dynamic. Because again, there are pockets of weakness, there are cracks in the economy, and those cracks, we've been hearing people talk about cracks for the past 18 months, and they just haven't led to some sort of calamity event, right? And that's totally fine. And so I think that in a resilient and dynamic economy, induced by QE, and now we have a disinflationary environment, because again, the market is forward-looking. So now, basically, QT is essentially behind us. Right? And the Fed has geared us towards the next move unequivocally being a cut. And we could debate the timeline of when that cut is going to come. But the market understands almost unequivocally that the next move is a cut. And so based on that expectation, we're seeing multiples expand. And so this is going to, so long as this environment stays in place, which is disinflation, resilient and dynamic macro dynamics, and the market pricing in a cut, then the bull market's going to be intact. right? And look, there have been so many risk events that have come out into the market over the course of the past 18 months when the trend has just been moving higher. And even over the course of the past 2 years, 4 years, whatever the case is, we literally have, global geopolitical conflicts. We had a global health crisis, all of these different things taking place. And so, despite all of those things, I mean, one of my favorite phrases is the market climbs a wall of worry, right? Mm-hmm. Because the market knows these things exist, and yet it still continues to go higher. And so again, it kind of goes back to that hubris of individual analysts and just saying, like, if you think it's important, but the market doesn't think it's important, you might be onto something, but you maybe shouldn't act on the degree of that importance until the market starts to agree with you, right? Because there's going to be a lot of money that you're going to lose in between you thinking something is important by the time it actually might be important. And hey, maybe it won't be important, right? So
have those trade ideas in the trunk, but don't act upon them until you see some kind of confirmation via market pricing.
Yeah, or act on them, but have a willingness to get out of that trade if the market eventually does not agree with you, right? One of the things I say is it's okay to be wrong. I'm wrong all the time. It's not okay to stay wrong, though, right? We can't operate with cognitive dissonance in our own alternate version of reality where we think we know better than the market and what's important versus what the market deems to be important. Just default to what the market is telling us. Be humble enough to listen. Have your perspectives, have your views. Be willing to adapt and manage risk, right? That's really what it comes down to, in my opinion.
Absolutely, and that's where the money is made. So you mentioned your 3 reasons. I think you had a longer bullet list earlier. I don't know if you can recall all of them, but you said a resilient and dynamic economy, disinflation, and the expectation of a rate cut. You've also said that Powell, I think it was you, that Powell is one of the best Fed speakers. Was that you or was that someone else?
Yeah, I've definitely said something along those lines.
Wonderful. So you see here, every time the Fed is cut, it's been the S&P 500 hasn't done terribly well. I mean, during an on-hold period in the 2000s, the S&P 500 wasn't doing well. When the Fed cut, the S&P 500 didn't do well. But when Powell was chair, when he started these maintenance cuts here, these little 25 basis point cuts like the ones that the market is expecting now, the S&P 500 did really well. It went from 2,900 all the way up to 3,300. Ceteris paribus, obviously, like personally, I'm not expecting like another COVID event. I mean, fingers crossed, hopefully it didn't jinx anything. But like Powell has clearly been able to effectively manage rates and do these maintenance cuts without creating like a huge crash or precipitating it or whatever chicken and egg scenario happens. Do you envision Powell to be able to do the same thing here? And would you attribute the fact that the S&P 500 went up here to Powell's management of doing these maintenance cuts rather than cuts that only happened after a crisis with other previous Fed chairs?
Sure. If you don't mind, zoom back out there so we can encapsulate those cuts from the early 2000s. So, one of the things that I've referred to this upcoming rate, because there is an upcoming rate cut cycle, and I've referred to this as disinflationary or non-recessionary rate cuts. When we look at 2018-19, those cuts happened in a non-recessionary environment. If we look at the cuts in 2007, 2008, if we look at the ones in 2000, 2001, those cuts happened basically at the onset of a crisis, right? We had something that forced the Fed to move, right? And so when we look at things right now, this is where I've been saying, like, a lot of people come back at me and they say, oh, cuts are actually bearish for the market. No, context is key here. We need to embrace nuance, you guys. So why is the Fed cutting, right? That's what's key, right? What is forcing the Fed to cut? And is that the end of a inflationary spike period, right? Like we're likely heading into right now? Or is it because shit is hitting the fan and we're seeing, massive banking failures and housing crises unfold, right? There's a massive difference between those two environments. And so I think, again, that's very clear, right? So when we look at that 2019 bull market, I think the market was up about 25% that year for the S&P 500 on a calendar year basis. I remember it was vividly. It was such a banner year for stocks. And unequivocally, that happened because of the rate cut cycle. In addition to other things, right? Markets, asset prices, they're multivariate, right? So there's all of these different things that are taking place to kind of facilitate that. But again, yeah, I 100%, my view is that Powell is probably one of the best diplomatic Fed officials we've ever had. And I think he's done a rather excellent job of managing through this crazy period that we've had in the U.S. economy over the past 8 or so years as he's been Fed chair. I personally would rank him the second greatest central banker of all time after Paul Volcker. And has it been perfect? No, there's been a lot of mistakes, right? Like, him and the Fed calling inflation transitory in 2020, 2021 is going to be a mark on the reputation of the Fed and Powell during this period. But I don't, my mom raised me and she used to tell me, don't let perfect be the enemy of good, right? And so I don't want to look at Powell and say, he wasn't perfect. He didn't get 100% of things right, so he's been a terrible Fed chair, right? It's like, no, given the context of the crazy world that we've been in, especially since 2020, I think he's done a pretty damn good job. Have there been certain aspects that I disagreed with, or maybe this, that, and the other? Yes, but I'm not Powell, he's not me, right? So I just need to judge him in a vacuum relative to other Fed chairs, and I think he's done excellent. One of the things I give the Fed and Powell in particular a lot of credit for is the way I've kind of phrased it is maximizing their optionality. And they basically give themselves a lot of wiggle room and flexibility to change the course of monetary policy based on incoming data. And I love that because that's how I operate as both an investor and as a trader and as an economist. As the data changes, so do I. So does my stance. So does my outlook. Because I'm going to be objective. I'm going to be data driven. And I think Powell, again, it hasn't been perfect, but I think they've done a pretty damn good job of being pretty data driven. And again, maximizing their optionality for monetary policy going forward.
Absolutely. Couldn't agree more. And I mean, it's visible in what has happened. It's readily visible in what has happened. And no Fed chair has had what Powell has had thrown at him, and Powell has navigated very, very well. For the S&P 500 to have done what it's done during that period, and for him to remain as balanced as possible, and like you said, right, very, very dynamic and data-driven as well. I too think that relative to other Fed speakers, they've done a pretty excellent job. From a macro perspective, we just had a Fed speaker, I can't remember who, come out yesterday and talk about their expectation that the labor market is going to soften this year. We've seen kind of sporadic softening, not a huge widespread softening, but like you said, there are pockets that aren't as strong as other pockets in the U.S. economy. On a large scale, on a macro perspective, how do you view the U.S. labor market developing into the end of the year, and how do you think that's going to affect asset prices?
Perfect. So my expectation for 2024 coming into the year was that we were going to see continued resilient and dynamic nature of the broader economy. But I also said expect to see some softening, and mostly a steady softening, right? I've kind of referred to it as sprinkle in some softness, right? We're going to see months where things say, oh, that data point really weakened, right? Why did that happen? Okay, let's think about it. And then the next month is going to come back and be resilient and dynamic. And I think the labor market has really kind of proved that to be the case. If you look at initial unemployment claims, they've basically been going sideways for the past 2.5 years, right? We've seen some cyclicality where it'll have some pickup to 240,000 initial weekly unemployment claims, but then it'll go right back down to 210, 212, 218,000. And we just kind of chop around in that range, right? And I think historically that's been a relatively healthy area to have labor turnover. I remember in basic early macro courses that I took back in college, one of the things we talked about is you actually don't want an unemployment rate of 0%. You want to have some natural churn within the labor market so that people can find the best opportunities for them. And basically, it just kind of cultivates, like having a cull cull within the labor market is actually quite good. That obviously means we don't want to see unemployment at 6% or 7% or 8%, right? There's a sweet spot here. But I think when we look at the labor market in particular, I even think the Fed's dot plot was calling for like 4.5% in the unemployment rate by the end of this year. I'm not sure where their latest dot plot was at, and I think they were calling for like 4.6% in 2025. And I'll just kind of default to them. Those are their expectations. It's not necessarily a prediction. One of the things that I've said though is, if we get the unemployment rate, right now we're at 4.0% as of the latest non-farm payroll data. If we get that trend up into 4.3, 4.5% over the course of the next 6 months, I just want to contextualize. Historically, that's a very low level of an unemployment rate in the U.S. economy. It's by no means recessionary. Certainly from a directional perspective, it's not trending in the right direction. But again, one of the things I've talked about a lot is that softness in and of itself is not weakness, right? Softness can become weakness with enough deterioration. But, let's see, right? Like this economy, this labor market, this U.S. consumer, the stock market, the real estate market has given us a lot of signs that it's very resilient and dynamic, right? And it's like if you're in a boxing fight and you keep punching your opponent and he keeps getting up, right? You keep knocking him down and he keeps getting up, his face is bruised and bad. You're like, man, who the hell is this guy? Or it's like Nate Diaz in the UFC, right? And he just keeps getting up, he keeps coming forward, he's like a zombie. And at some point you have to look at that opponent, right? Or in this case, the economy, and say, man, no matter what I throw at this guy, no matter what I do, he keeps getting up and he keeps coming forward. Like at some point, you're just gonna say, man, this guy's really strong, right? This guy's super resilient and dynamic. This is a feared opponent, right? This guy deserves a lot of respect. And I think this economy in a lot of ways has not earned its respect, right? Or excuse me, it has earned its respect, but it hasn't been given the respect that it deserves. And so in a lot of ways, we should expect to see some of that softness continue. And then it's just a matter of pace, right? Because how fast does that softness deteriorate into outright weakness? Or can we still kind of walk this tightrope of softness but resilience and dynamic overall, right? And my basic belief is, again, it's like that boxer, he keeps coming forward after you keep punching him. It's like, okay, this guy's resilient. He's going to keep coming forward, right? That's the trend. So, I see that, and, there's a lot of there is a lot of really good things taking place in the U.S. economy. So I look at that, and I think it just kind of deserves its respect. We should expect to see the labor market soften, but my general view is that it's going to stay resilient and dynamic.
Absolutely. Yeah. And in the vein of contextualizing, just per what you said earlier, this is the historical level of the unemployment rate, right? So, 4%, this is considered extreme cycle lows. So for us to be rising off the bottom and to be at 4%, this is even nowhere near the long run average, right? Even over the last 50 years, right? So, the long run average is more like 5%, if that, right? Non-recessionary periods, and then 6% once it starts to get a little bit worse. But rising off the bottom, 4% is not even remotely elevated.
Yeah, and again, like I look at this chart, right? And when we zoom out as we are right now, it's like, man, every recession is like a precursor to that recession happening is a steady and consistent rise in the unemployment rate. And so objectively, we need to look at that and say, okay, well, the unemployment rate surely is rising steadily, right? So, if we just from a basic perspective, just look at that trend, I understand fundamentally why a lot of people are concerned that a recession is still around the corner. I've never once said that a recession is not coming. I just think that the better bet for investors who are implementing macro in their analysis is to recognize that the economy is resilient and dynamic, and we should stay long and strong while the music is playing. You have to dance, right? And so if we see something like credit spreads really start to widen and deteriorate, in addition to a 4.7, 4.8% unemployment rate, a decline in labor force participation, a decline in average annual income, or so on and so forth, right, on a year-over-year basis. All of these things would certainly set off alarm bells that I'm not going to ignore. The problem is those alarm bells just aren't going off, right? We have some data points, but when you look at the weight of the evidence, it's just not there yet, right? So I'm not saying things are all clear, close your eyes, throw caution to the wind, and just buy stuff, right? Or, don't ignore, or, don't even focus on macro. Macro is a huge piece of what I do. And I'm looking at all these data points constantly. But, exactly as you mentioned, right? It's if you're just looking at the unemployment rate in a vacuum relative to the historical average, we are still extremely low. And even if we got to something like 4.5%, it would still be very low.
100%. In that vein too, let's talk spreads. I have the chart in front of me, and one thing you said earlier was that people will I tend to think that a lot of people do not contextualize Fed funds. They do not contextualize treasuries, and they'll just look at Fed funds at 5.5 or 5.25, and they'll say, whoa, this is really bad for businesses. But look at spreads. Look at what they have to pay as a premium over the risk-free rate. They're still extremely low. Like, I would consider up here the danger zone. If we overlay it with the S&P 500, you could see kind of once we cross this threshold of 2% on investment grade and then like 7% on high yield, then it starts to get hairy for the S&P 500. Over here too, it didn't start to get hairy until we breached those levels. Right now, investment grade borrowers can borrow at less than 1%, and high yield borrowers can borrow at a 3.1% premium, right? So contextualizing data is so important, and we haven't even risen off the bottom here.
No, that's exactly right. Credit spreads are huge in what I do. And Joe, if you wouldn't mind, can I share a chart of my own?
Of course, yeah. Let me stop the screen share. Yeah, of course.
We're going to stay on topic here. Let's go screen. Wonderful. All right, we're in business. So on the right-hand side, we're looking at the high yield credit spread. I've actually inverted it and I've overlaid the S&P 500. Guys, this is a crystal clear correlation, right? This is super, super important. And what this shows us is so long as credit spreads are both low and falling, in this case, because I've inverted the credit spread axis, in this case, rising in the blue line, then the stock market should continue to remain elevated and rise as well, right? This is extremely important. And I think, just another kind of piece of context on this, I'm not able to pull it up. Okay, that's fair enough, right? So I think that in and of itself is telling us so far things are all clear. You can also do something very similar with the VIX, right? Just looking at volatility index. And that's basically telling us the exact same thing, right? Which is that there's no reason for panic at all right now. There could be 3 months from now, there could be 6 months from now, but right now the market investors are telling us on the aggregate that things are all clear, right? And so again, we can have a perspective today and be willing to change our mind 1 month, 3 months, 6 months down the line based on an objective review of the evidence and taking the weight of that evidence, right? So I think that's very clear. And I loved what you said too about, basically looking at where Fed funds are as well, right? And this kind of ability to position people on the curves in different investments where, it's like, it makes a lot of sense.
100%. Yeah, no, it's being objective and data driven. It's where the money is made, but it's not where the Twitter followers are made, unfortunately. In your case, it's been a slow grind and you're crushing it with followers, but I know that, if you destroy your credibility if you become a doomer or you don't become data driven, but it certainly helps with the Twitter followers. But one thing that I know is that the Twitter payouts certainly don't surmount to much compared to the investment returns you can make just by being a data driven person.
No, that's definitely right. And I mean, you also hit the nail on the head there too, right? I think one thing that I learned several years ago is that being bearish, operating with a doomer perspective is in a lot of cases a business decision, right? Because if you're advertising a potential crisis, then you naturally create demand by offering to sell the solution, right? And so I don't want to.
And if the solution is the solution is watch the podcast or buy this or gain access to my portfolio, it's always there's a product to be sold when you're operating under that. Couldn't agree more. Continue.
Invest in my fund, let my firm manage your money, so on and so forth, right? So exactly, build it and they will come, right? So if you only focus on the negatives and sell a crisis, then naturally people are going to say, oh man, this guy has my best interest in mind. He's trying to warn me about something. I need to listen to him. Okay, what does he have for me, right? And so it really is a business decision in a lot of these cases. And I used to get really mad when I used to see people focus on only half the data. And then I started to realize, these people aren't just ignoring that data. They're purposefully not talking about it, right? It's not that they don't know about it. Oh, they know about the full picture. They know about these other things that are taking place to counteract this negative perspective. They're just choosing not to talk about it because it doesn't fit the narrative that they're trying to portray and market.
100%. Absolutely. Yeah. Not nearly as fashionable. Let's talk about the money supply, and then I want to talk about cubic analytics a little bit, if you don't mind. I want to get the story on that, and you can direct people over there as well. So you had a chart back in May talking about M2 money supply growth accelerating. The top was total M2 at 20.867 trillion. The bottom pane of that was year-over-year M2 growth at plus 0.6. This is coming off of M2 money supply declining for about, I think it was a 7 or 8 month period. So asset prices happen to have a local bottom at the exact moment that M2 bottomed. Talk a little bit about how M2 money supply folds into asset prices.
Well, again, if we kind of think about, M2 is different than QE, right? And like total assets on the Fed's balance sheet, but these things are all interrelated, right? So it is kind of interesting that we could see something like the Fed's balance sheet continue to decline, but now we are seeing something like M2 reaccelerate on a year-over-year basis. A lot of that is due to base effects. It's really just kind of been trending sideways, but more recently in the past several months, it has been actually ticking higher for M2. And so I think that's very important. Again, one of the reasons why I became so infatuated with monetary policy and the Fed and just generally, currency topics in general is because I recognize there is this really close relationship with asset returns, right? And so whether you denominate the S&P 500 in M2, or if you're looking at the year-over-year rate of change in M2 or the Fed's balance sheet relative to the year-over-year rate of change in the stock market, whether you pick the NASDAQ or the S&P 500 or something, there is not always going to be a perfect relationship, but there's a pretty clear relationship on these things. And so, yeah, I think that I can't explain to you why we are seeing M2 reaccelerate. I know deposits in and of themselves have been growing, and I think it's checkable deposits, so on and so forth. But from the standpoint of just understanding, hey, there's this piece of information, M2, it's rising. What do I do with that? For me, I've just internalized that saying, hey, this is probably bullish for asset prices on the aggregate, right? So again, this has been something that I've been looking at and just saying, hey, it's another justification to recognize that the music's playing, we got to dance.
100%. And for you too, I mean, you mentioned at the top of the hour, I'll say, because we're coming up on that, I guess, was that you try to look at what the most important data points are for you so that you can outperform, or at least meet or outperform, the S&P 500, and deep diving into monetary policy and deposits and M2. You're not trying to get a PhD. You're trying to perform at the same level of the S&P 500. And so a lot of people will fall into one or two things and try to become an expert on them and trade off of all of them, rather than looking at the data that's actionable and then becoming an expert at monitoring all of that in a balanced way. And you've done a really good job at that.
Thanks, man. Yeah, I mean, for example, I get a lot of people ask me about the Bank of Japan. I'm like, shit, man, I am not an expert in the BOJ, right? Yeah. I can't tell you too much about their history. I read some, monetary policy history books about the Bank of Japan when I was in college. But in terms of, I just don't want to spend my quote unquote precious time is scarce. I don't want to spend my precious time worrying about something that might not have an actual outsized impact. It's like the input of my time needs to have a corresponding output. And so for me, it's like I'm just going to focus on the things that I've mastered or found to have an outsized return in terms of putting in my time, having some degree of input, and generating an output as a result of that. And so, first of all, I appreciate that, man. Thank you. And I think you just kind of hit the nail on the head. I think each investor, each trader, each market participant, each economist prioritizes different things, right? And I think one of the things that I've learned over the course of my 10, 11 years in markets and as an economist is analysis is much more of an art than a science, right? Because I guarantee you, all of us who are on Twitter, all of us who are involved in markets, we're all looking at the same data. But how is there such a dispersion in the success, right? There's people who are way more successful than me at investing and making calls about markets and the economy, and there's people who are way worse than me, right? And there's this huge dispersion, yet we all have the same ability to look at the same data. We all have the same access. For example, I don't pay for a single research tool. I don't pay for anything. And so I'm getting all the information, all of my inputs for free, right? And meanwhile, there are other people spending tens of thousands of dollars a year on data and research and analysis where, they might not be getting an equivalent output in terms of that input, right? So clearly there's something here is what I've really thought a lot about over the course of the last year, actually. Because I think really over the past 12 to 18 months, we've really seen a dispersion of outcomes for investors, right? Some people still have not reinvested in the market since 2022 because they still think that this pending crisis is coming. Hey, they might be right, but what I'll tell you for a fact is there's been a lot of money to be made over the last 18 months. And so, I think that's really important. So again, it's so interesting to really kind of come to the realization in a lot of ways that investing, being an economist, being a trader, being an analyst is much more of an art than a science. It's so much more subjective. And so I think you unequivocally need to find what works for yourself and be really honest about whether or not this is actually working, right? I used to think that being a gold bug was really going to work for me. And I was like, oh, this is really going to pay off. And I had to look myself in the mirror and say, shit, this really is not working. I need to reassess and reevaluate what's going on here. I can't keep calling a top in the S&P 500. We keep making new all-time highs, right? What's going on? I needed to think critically. I needed to be introspective. So I would encourage anyone who's watching this to do the same.
Absolutely. Could not agree more. Yeah, the people who have not been introspective have left like 2,000 points on the table in the S&P 500 since, they've stayed bearish since the bottom in 2022. Yeah. Let's shift gears to cubic analytics, man. I want to hear the story there, what you've been working on. I'm on the welcome page now. Some of the quotes here. My favorite newsletter to stay up to date on all things macro. Cubic Analytics puts out high quality research on macro stocks and Bitcoin. Their free stuff is already great. I can wholeheartedly recommend upgrading to a paid subscription. You're over 11,000 subs strong now, man. What's the story here? And how have you kind of built this company, built this brand of yours?
Yeah, so I'll give you the quick elevator pitch. After I graduated from UCSB with a degree in econ, I worked in banking for about 2 years. During COVID, I had a whole reassessment about how I wanted to live my life, how I was going to define success, what I wanted out of career, life, happiness, the whole 9 yards. And again, right, like I had a perspective about what I wanted to do with my life, be in investment banking, so on and so forth. And I was like, oh, this was the wrong decision. I need to change my mind, right? So I decided in 2020 that I was going to start sharing analysis unfiltered on social media as a distribution platform, but as best as I could as a one-man show, try to produce institutional quality research. And again, just talk specifically about the economy, the stock market, and Bitcoin. And so when I launched my newsletter in May of 2021, it was literally just called Caleb's Market Update. I have zero background in marketing or anything like that. And about a year later, I changed the name to Cubic Analytics. I designed a logo. And so I've just been sharing long form analysis for free every single week since 2021. And people seem to really resonate with it and appreciate the free research. And then of course I also offer a paid service, but I really just encourage people, just sign up for free. If my message and consistency and the approach resonates with you and you develop a degree of trust with how I approach markets and investing, then sure, come see, what else I have to offer 100%. But I think it's just been really fantastic. It's been a beautiful way to connect with so many people. I think right now around 11,600 total subscribers. We have almost 700 paid members in the premium community, which is just amazing, very surreal. And it's been fantastic. I've been able to meet people from around the world who are subscribed. It's really insane. I've been living in Europe now for the past year and a half. And yeah, no plans on slowing down in terms of doing this analysis or anything like this. So this is what I do. I live, breathe, and eat this stuff. So I'm not going to stop.
Clearly, 100%. And yeah, for everyone watching, obviously this will be shared to Twitter. It'll be shared like wildfire after people listen to the first 5 minutes, because this has been such a fruitful discussion. So everyone listening, go check it out. You can visit Caleb's profile, the same handle that you see at the very top of this tweet. Click into Cubic Analytics, check it out, take a look. I promise I'm not being paid. I've simply found so much value in Caleb as an analyst over the last 12 to 18 months. He's been so consistently right. And of course, we all get things wrong, but he has been the most consistently correct and balanced analyst on the platform. So if you want some non-sensationalist stuff that, not investment advice, but can actually make you money, check him out and check Cubic Analytics out. Caleb, thanks for being on, man. Any parting thoughts on the market, any parting thoughts you'd like to leave the viewers with in this discussion?
Joe, first of all, thank you so much for the kind words. I really do appreciate that. I'm far from perfect, but like everyone else, I'm just trying to do my best. So again, I really do appreciate that. In terms of parting thoughts, let's see here. Not really, man. We covered a lot of great stuff. I'm actually at a loss for words. So look, connect with me on X, hit me up. You could DM me. I'm open to having a discussion with anybody about any topic. And I'll see you guys online 100%. And this was great, man. Really enjoyed this.
Wonderful. We'll have to have you back on. I have to have you on my other show too. 100% of the viewers over there would love it some other time, man. But again, thanks so much for your time. That's Caleb Franzen, everybody. And this is, of course, for Thea, the world's simplest Bitcoin self-custody solution. Download it for free on the iPhone. Take a look at yourself. Single sig and multi-sig vault. Set it up in 5 minutes. Take your Bitcoin seriously the way it was supposed to. Caleb, thanks so much, man. Take care.
Cheers.